Peter Churchhouse is Advisory Director of Morgan Stanley. He's in our Hong Kong studio. Pete, welcome back to the show. Thanks a lot for being with us today. The numbers, let me start off with the numbers that we came out last night. It's an interesting, well, I mean, it's always been lots of negative and positive factors about the US economy, but last night's Conference Board data showed the jobs hard to get index has worsened over the past year, which is an interesting thing. I mean, it's an index that people do tend to pay a little bit of notice to, but then consumer confidence is still rising and still very strong. It's really hard to know how to interpret this. How do you think Greenspan is going to look at that?
Well, I think that's probably his biggest concern, is that clearly we are seeing an economic recovery in the US, and this looks sustainable, but it does look like a job-light recovery. I don't say job-less recovery, because if you think back a few months ago, we had some very powerful job recovery numbers, but again in December they've gone right back again. So I think that's his biggest concern. On other aspects of the economy, I think he's quite comfortable in terms of resurgence of capex, the consumer confidence side, as you mentioned. But this is the big worry, and I think that will be what drives the policy as much as anything. This jobless or job light recovery that he's seeing.
The job-light recovery, most people that we talk to these days, particularly those bulls out of the US, say it's only job-light for the moment. By definition, as night follows day, jobs will follow economic growth. Is that fair?
Well, that's absolutely correct, and I think that's the doctrine that Chairman Greenspan is hanging his hat on at this point, and that's probably correct. But I think what's also driving the job-light recovery is these significant productivity increases that we've been seeing in the US economy over several years now. This is not a flash-in-the-pan thing, and I think that's perhaps what's actually driving the economy this time round. Normally at this stage you would see jobs surging rapidly, unemployment coming down quite sharply at this stage of an economic recovery, but perhaps it's the productivity improvements which we're seeing in the US economy and have done for years, which is actually preventing this from happening. Is that a good thing? Probably is in the long term, but yes, jobs will pick up at some point, as productivity gains can't go on ad infinitum.
On the other hand, Peter, I'll cite the case of Kraft Foods once again, because the announcement of a slew of job losses, 6,000 jobs. They're saying that their industry, and this is a company ensconced in the average American diet, Oreo cookies, Oscar Mayer wieners, and they're saying that, you know, their price competition is so heightened they cannot fend off supermarket private label brands. So instead of trying to battle them on a losing front, they're going to cost cut and use that to offset market share, which is dwindling. Isn't this going to be the case? I mean, you've got Chinese goods continuing to pour into the United States. You're going to have more consolidation. People looking at cost cuts as a way of keeping profits up rather than productivity leading to increased output, therefore more hiring.
Cost cuts in the US have been a part and parcel of the US economy really for the last 5 or 7 years. This is nothing really particularly new. The outsourcing of production, we've seen the Kmarts and the Walmarts of this world pouring their production into markets like China, again suggesting that there is just a continual pressure on pricing. The American consumer wants goods at lower prices, and he's going to get those goods as long as we've got markets like China and India able to provide those goods at increasingly lower prices. This is not going to change, I don't think, over the next year or two, and certainly that's I think, behind most people's view that US interest rates aren't going to fly through the roof. We're not going to see an inflationary binge as a result of quite strong economic recovery. But yes, margins will continue to be under pressure, and as we expect this year, the very high corporate profit results of last year will tame down again this year to what you might call a more normalized level as a result of these price pressures.
So what we're looking at, though, Peter, is the situation at the margin. Yes, interest rates are not going to fly through the roof anytime soon. However, we still need to see Alan Greenspan acknowledging at least that the next move is going to be up, don't we? Because we're still talking about foreseeable future, that phrase, aren't we? Is he going to come out of this meeting by saying, okay, we're not? Is he going to remove that phrase from his advisory?
I think the suggestion is that the language will stay the same, that the low interest rates for a considerable time will remain as the doctrine. Now, what is a considerable time? Who knows? But our guess is that by the middle or the third quarter of this year, that language will certainly be changing. We will probably see corporate bond rates and interest rates moving up before that time, reflecting increased investment, increased capex on the part of the corporates. And I suspect that beyond that, you will then see the Fed starting to look at tightening as well. We're expecting about 4.8% real economic growth this year, which is a significant uptick from last year. So within all of that, you can expect, I think, to see improvements in jobs and perhaps some very mild uptick in inflationary pressures, but nothing really major.
All right, in the light of that then, obviously the dollar is going to get no support from the potential for higher interest rates in the US. We'll talk about that in just a second, Pete. We're going to have to slip in a quick interest rate break commercial break. We'll be back in a couple more minutes to talk currencies with Peter Churchhouse of Morgan Stanley. Stay with us. Welcome back to Market Watch. Over in our Hong Kong studio, Peter Churchhouse, Advisory Director at Morgan Stanley in Hong Kong, is with us to chat about the future for the US dollar. Peter, we've already assumed that we're not going to see an interest rate rise in the United States, which is one potential support for the dollar removed. But I just want to talk about the greater dynamics here, if we could, for a minute, and perhaps the long-term implications of what's going on. It's interesting to note that while the US talks strong dollar policy, clearly the policy is to drive it lower. And it's also interesting to note that Asian currencies have barely gained at all at the expense of the dollar. They have been devaluing quite quietly along the way without any of the political pressure that you would expect to come from that, even though that has been rising a bit. At what stage is Europe going to turn around and say, listen, we're going to get into this devaluation game too. If it's going to be competitive devaluation, why the hell should we pay for it?
You ask the question when? I would say next week. The G7 meeting, I think, that will be a key issue on focus at the G7. If you think about it, the US dollar or the euro has gained 40-odd% in the last 2 years against the euro. Against the dollar, and our calculations are that the euro is probably 15 or 20% overvalued right now. The euro has actually gone up not through any fundamental strength in the European economy, but really by default. And I suspect that we're probably 3/4 or maybe 80% the way through this correction in the US dollar would be my guess. And I suspect you will start to see some kind of intervention by the ECB going forward over the next few months or so. Perhaps not as aggressively as the Bank of Japan in that situation, but I think that's probably what you'll see. Less of a rate cut prospect in Europe, but more of a prospect of intervention and exactly to arrest this overvaluation.
What are the implications of that relationship across the Atlantic for Asia? It wasn't that long ago that what the United States is doing with its dollar, spoken or not spoken in terms of policy, was exactly what they were slapping us in Asia for doing with currencies here, particularly I would cite in the case of the Chinese.
Yeah, absolutely. And I think if you look at the G7 countries, you've got significant policy differences on currencies between the three major blocs, between the US, between Euroland and Japan. And you're going to find it, I think, quite difficult to get some sort of consensus on how this currency situation is going to be resolved. But I think the US will, it's a case of, will Euro side with the US against Japan in the G7, or will Europe side with Japan against the US? My sense is that they're going to side with the US with a view to putting pressure on Japan to ease back on its intervention. So I think there's going to be pressure on all three groups here, and I think if there is a consensus, it'll probably be focused on Asia rather than on Europe, where Europe has taken most of the strain of this currency adjustment so far. So I think they're going to try and force Japan to take some of the strain as well.
In that circumstance, Peter, if we do see that happening, and we also see the US dollar beginning to stabilize from its descent, as you have been suggesting, then what would be the imperative for Japan and China in particular to continue financing the US external debt? If they're not getting competitive devaluation out of this, I'm talking China in particular and the other Asian currencies, and if they're being pressured to start appreciating against the dollar, there is no reason for them to continue funding the the current account situation in the US, is there? Is there a potential that they'd then sit back and say, there's nothing left in it for us?
What do they do? What do they do with their trade surpluses? They can't put them all in Aussie dollars. They can't put them all in Canadian dollars. It really has to be the US. And even as the US dollar has declined, you've seen the current account surpluses of Asia have been largely funneled into US dollar denominated assets. They have not gone into European assets where the currency is appreciated against the dollar. So I think if the US dollar stabilizes, there'll be even more reason for the current account surpluses from the central banks of Asia to go back into US dollar denominated assets. I don't think there's a big issue here at all. And as we see, if we see the US economy recovering a little bit this year, we're going to take the pressure off the current account problems to some extent. And I think the pressure is going to focus back on Europe, where the economic fundamentals aren't that rosy, and we certainly don't see the kind of recovery in Europe that we're seeing this year in the US. So I think this is going to be switched around over the course of the next few months, and the negative issues are going to focus on Europe rather than the US dollar.
All right, Peter, we'll have to leave it there. Thanks a lot for coming and talking to us this morning. Peter Churchhouse is Advisory Director at Morgan Stanley in Hong Kong.